So I've got the recording going. As always, we'll start with the disclaimer. Not financial advice, only my own and other speakers' personal opinions. This is not to encourage or promote taking any trades, positions, or investments of any kind. Any information contained in this conversation is for informational purposes only and to be taken as is. Wong and other speakers have done their best to ensure accurate information, regardless of anything to the contrary. Nothing available in this conversation should be understood as a recommendation. Consult a licensed financial professional in your jurisdiction. This conversation will be recorded and posted for future reference. So today's topic is gray box versus black box. I think this is an interesting topic because a lot of firms actually use the gray box approach. There's kind of this apprehension for pure black box thinking, and it it poses a very interesting question. I will invite everyone to the stage since we have a small group today. And how a human and the machines interact, what type of differences there is, and not only in risk management, signal management research, but also, you know, the overall integration. Because, okay, my real experience using a gray box approach was when I was many years ago interning at a options firm, and I would say a majority of the work there was gray box. And what do I mean by gray box? There is some human action, whether a decision that is taken prior to execution. And that means anywhere on the path from you have a signal, you are calculating a signal, you are generating a model, you are executing the trade, you are structuring the trade, you're risk managing. In any of those scenarios where there's a human, I consider it a gray box. Pure black box would be all of that kind of process chain that I had laid out would be automated. And so when we consider the major differences, there's actually a lot of different places to insert the human. So again, I'll go back to my really only experience ever using a gray box in this options firm was that the models were tuned to price and look at volatility. And then a human would be running different algorithms, and you would be monitoring these algorithms, and you would be monitoring the model's output, for different tenors, different volatilities, and things like that, and trying to either structure good trades. And these things would be taking things into your book and out of your book. Not quite specifically market making, but I would say there was a lot of liquidity provision because it was a pure prop place. And the traders would adjust the parameters based on what they thought about the market. And I thought this was quite interesting because you would have people who had, decades of experience. And at this time, people still had floor experience. Looking at the order books, they used to have the squawk box back then. You would be listening to the pit and you would be upstairs and you would have your algorithms being able to post or ladder in for you or out for you or whatever. You'd have your general risk metrics, and then you would be adjusting these parameters as you see fit, or you hear things coming off the squawk, and then some people would adjust that, or you have incoming news. My biggest contention with gray box trading is it requires skill from the human. And that human skill is not back testable. I mean, it could be over your entire career, and if you were like some of these, senior traders, senior portfolio managers, who have their own capital from being successful on the floor, they had already been battle tested. But if you're trying to give someone this gray box without a significant level of training, it can be extremely difficult because of our inherent cognitive biases, which we have covered quite a lot, but also being able to adapt correctly to a set of situations. Because if the human intervenes, adjusts parameters, or adapts incorrectly, that's negative expected value. So as always, this is open. I've invited many people to the stage. Let's get this conversation going. Please, any comments, questions that you have on the topic, or anything else is good.
Hello. Uh, when you describe the different types of boxes, gray and black, I was just thinking that the gray box sounds like discretionary trading and black box like systematic. I personally would think that gray or black box both should be systematic and not talking about the discretionary trading at all. That is like reacting to news or adjusting the parameters about what you think about the market. And when I first saw the headline of today's topic, gray box, black box, I was thinking to myself that I would think gray box something like more a long term, like trend following, where your positions you hold them for weeks and months, and you don't need to automate everything. And maybe it's more like based on a theoretical concept, while as black box is more like working on empirical data and is the one that is automated, so you don't understand much what is happening behind the scenes.
I wrote down two interesting points that you made, and I agree with you, Marcus. There is definitely a line between systematic and discretionary, and I think of systematic as you're pregnant or you're not. So any what I just explained um, is what I would consider now. Now, with my kind of understanding a discretionary aspect. And because the human has so much control to change those parameters of that underlying system, at speed, at will, um, it would fall more. It would fall into that discretionary bucket. Now, the other thing that you had mentioned was the idea that gray box is longer term, but not everything is automated. And I think that that's an important distinction because the technology aspect of gray box versus black box and kind of the market's preconception and what is systematic. Systematic should be 100% following the system. It doesn't need to necessarily be 100% automated, and that's where the analogy to trend following I do think is systematic, but not necessarily fully automated. You can execute a trend following system, longer term systems by hand, but as long as you're doing it exactly as the system would have done, then it is systematic. And by that measure, because the logic aspect is fully inside the rules, I'll say that it is a black box because the human is not intercepting the logic or the parameters in any way there. You are just the hand that executes the black box's will. While in the gray box scenario, you have control of, like, your will is being expressed through automation, like a cyborg. You have all of these bolt-on kind of added systems, algorithms, calculations, models coming into you, and then because you have that final say, um, then that is executed into the market. the empirical part, I do think actually it applies to the trend following aspect as well, and that goes to both. I cannot imagine anyone designing any kind of system, whether that's in the cyborg method where you have some model and you're trying to execute against that, but you have potentially some discretion over it, or you have a fully black box system whereby the system is automatically executing by itself, and or you, the human, have a list of trades or however it's outputted in Excel, and you send it to your broker, and there's a human on the other end of that, whether it's you or your broker or however, executing that trade.
Yeah, that makes all sense, and I agree totally. Uh, and even, I mean, even if you have like a trend following long term system based on theory, not just empirical data, you obviously still backtest it and crunch the data. But it's just, I think there's a difference if you're like a bigger institutional systematic trader or a smaller retail like myself, because I take all the signals that are generated systematically, fully automatically, but I don't see the reason why I should totally automate the order execution or order placement when I hold the positions for days, weeks, and months, and even over a year. So I kind of feel more comfortable doing it by hand, but I understand that there's going to be this human psychological element to stick to the plan and have the discipline not to break any rules. But yeah, these are my thoughts.
No, that I think that's a good point, and one I want to touch on, because in the full black box, because that automation is taken away from you, it takes the edge of the discipline away from the human. Now, of course, there's cost to that: technological cost, implementation cost, research to be able to make sure everything is done correctly, and confidence in whatever your code is or method to do that. Um, but it distances you from that because the system is going to execute automatically no matter what. That said, a majority of the time, and even myself, will execute systematically by hand, especially if that cost is not worth it. Because, like you said, if you're doing something, weeks, months, years, the overhead cost to run such a system is just not worth it, and you absorb the cost. Rather, you absorb the cost instead of monetary technology cost. You absorb the cost in discipline cost, because there might be that nagging suspicion in your head that this trade isn't going to work, or I've lost whatever. But if you are able to execute that all automatically, just like the black box system, then you have the same result. So for probably a majority of the people, you know, either here or on Twitter or other Jerry's Clubhouse, you will find that it's probably not worth it. There is definitely going to be some kind of hurdle, like a hurdle rate or a hurdle return, whether that's in your psychology of discipline, that needs to make it worth it for you to invest into that type of technology.
I don't mean to change the topic or shift the focus, but I wonder how much of getting back onto this question about execution or other aspects that you decide to systematize or not. I wonder how much of that it's related to finding an edge. Yeah, I understand. I understand that discipline is an edge. So of course, if you can do it, you better do it programmatically, because you're not going to have a problem with not trusting yourself and blah 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 when in fact you have to pull the trigger. But another reason for automating is also the possibility of adding more sophistication. I mean, I don't know how to run a slightly sophisticated order algorithm by hand. I know how to program one, and I know how to whether or not I could trust somebody else's. What I mean by that is not that if I know how to program something, I know the theory of it, so I know how to write an algorithm that does it. But the point is, I don't know how to keep track of very fast events practically. It's not a brain problem. It's just a practicality problem. Whereas a computer can be a lot faster than me. So in this black box versus gray box, certain elements I understand discretion. I think a lot of it is marketing, by the way. But discretion is something that should be very clearly outlined whether or not it's in the system. So gray versus black. But other aspects, I mean, order flow, for example, it almost always warrants automation, at least in my very limited experience. And I don't have a very sophisticated order management system, but still, I try to automate as much as possible.
I agree. I mean, I'm not I'm not a gray box person. It was a topic that came up and I have limited experience doing it. I think that black box can be better. I have and probably will continue in the future to implement some things by hand, especially if they're in the testing phase or I'm trying to figure out how to implement that. But the scalability and the precision of having something automated uh, is is a massive improvement, and it's a front loaded work, right? You front load your work, creating this execution algorithm or executing these things, and then after you're able to get through it to production, you are able to um, reap those benefits. So it is completely possible that you invest in doing this thing, and then you can actually live on the beach. Um, the order flow and things like that are definitely into the time scale where a human cannot react fast enough. Looking at order book imbalances, looking for stacking, looking for, not necessarily, well, I mean, in crypto you can spoof, but um, looking for orders that are not really meant to be executed is impossible. And what's very funny, I find that there's some of these educators out there on YouTube or on Twitter or whatever saying like, yeah, I'm an order flow trader. I can look at the order book and determine what's going on. I was like, you can't. By the time you've seen it, people have already reacted by the time you've blinked your eye. It is impossible for them to react at that speed. So, okay, rant complete. Um, if you are looking to play in that space, it must be automated.
Yeah, and that's exactly what I was trying to get at. I mean, so you weren't ranting; you're just hitting, the mark here. Certain things cannot be, construed in certain ways. I mean, you can't say I'm a systematic trader, but I like to do the execution myself because of what you just said. And I don't even know. I mean, as I said, I know very little about gray versus black, because I'm quite cynical about. I think most of it is down to marketing. Whichever flavor suits certain investors, you sort of paint yourself in that sort of way, in my opinion. But certain aspects can't really be you know left to manual execution. Even doing limit orders. Well, sorry, yeah, even placing limit orders, it could be problematic at times for a human. Unless you just said, okay, I'm executing all market orders, which is fine, and you take whatever price you take in the market, doesn't require any
Gross.
sophistication. Then that's the only part where um, I would be happy to just leave it down to the human. But then again, we go back to your first point, which is humans may not feel confident about following their own instructions and their own rules. So yeah, I mean, like it's a bit of a strange situation, this one, where some people like discretion, having discretion because it gives you more feel of control, but it doesn't work. And just to cite another example, I mean, there's none of our friends from the Friday room here, but the thing that Jerry was talking about, if my ATR, if I have a huge ATR expansion, should I take profits or not? Should I overrule my own rules? I mean, that's another very interesting gray versus black box question. And again, something I don't have an answer for, but it sort of highlights how contentious this point really is in terms of system design.
I think that that point you made about if something happens in the market, am I going to do X makes it a gray box. No matter if you are not systematic, 100% of the time you are not systematic. It's like you're pregnant or you're not. And I know it's a horrible sexist analogy. I guess we could say you're infected or if you're not. As soon as you start to allow that human element in where you're overriding, then it turns gray to me, because there will be future scenarios where you will be tempted to override. You don't know what's the net effect of your overrides. And if you're doing it infrequently, it could look like something's like it's helping just by random chance, and you continue to do more of it. That leads me down a very, very, what I would consider a bad path.
Yeah, I agree. I completely agree. And I also don't know what else to say about this topic.
Me either. It was on my list of topics that had come up in the clubhouses that I write down and then I put on the list. To be honest, I think it's Andy. Andy was the one who had recommended it and isn't here tonight.
I think it should be sanctioned. You should think about some punishment.
But Derek, you mentioned today that you are more a gray box type of trader, if I got it right. To be honest, on these clubhouses on Thursdays, Fridays, you have you have felt like to be the most one of the most quantitative or like systematic traders that I've understood, or it felt to me. So I was definitely thinking about you as a black box trader. But the question is like, how do you use the gray box type? I doubt you make any discretionary. Sorry, I on the street. I doubt you make any discretionary moves in your box, whether it's gray, black, or whatever. So, how would you describe your approach or mindset behind the gray box as you do it?
Oh, well, I'm sorry to have given you that impression. I was a young intern back then when I had learned to use the gray box at an options company. Now I am fully black box, and I think that the reasons I had outlined is why I felt that way. I don't think I could have gotten the skills to do those discretionary overrides or discretionary model changes in the case of the company I was working at, or understanding what is these kind of large overflows coming from the squawk box and all that stuff. I found it much more scalable for me to stick to what I'm good at, and which is to create quantitative models and have them execute as automatically and black box as possible.
All right, got it.
Well, since this topic is, let's say, doesn't have a lot of legs, does anyone have anything that they want to bring up?
Yeah, hi Derek. Maybe I'll chime in at this point. I would kind of distinguish in this topic between the holding periods of the trades. I mean, if you're doing short-term trading, if you're doing high frequency or well, let's say daily trading, then clearly the only way to do that successfully is to have a fully implemented black box where everything is done automatically. But if you're doing the sort of longer term stuff, then I don't think it's necessary to have it fully automated. I mean, even Jerry's stuff, I think if you get a signal and your model says, you're going to trade at the open of the following day. I mean, whether you have a system that puts in the orders or you do it yourself, the outcome is the same as long as you follow the rules and the instructions of your model, in which case it's still black box to me. The gray box to me comes from the point where you're trading something that's a longer term model and you get a signal and then you're going to decide whether you want to trade it or not. And I would say most of the time you are going to trade it, but you need to, or you will then take into account other external factors. I mean, if it's I don't know, if it's a single stock, is there an M&A or some event happening, or in any other case, is there an event, is there an election, a political situation that would grant the position to be taken, or if there's any other sort of major structural change. So I think there's a bunch of sort of quantamental guys out there who are trading these sort of models, and I think the last look is always with the trader, who then decides whether it's what you want to do. I think in most cases it will be the thing to do because you have back tested your thing, but there will be situations where you're going to say, hang on, now I don't want to do it because the risk reward just isn't there.
Yeah, I think that you make quite a good distinction there. I would say human executed black box is possible as long as you follow the rules 100%. So if you take a Jerry type strategy and you actually execute it 100% every time over the course of your career, it can be considered a black box. I think that the edge that Bruno was mentioning in the execution is proportional to your the length of your expected value. So normally, the longer time frame you'll have a higher expected value. So making one tick isn't necessarily going to actually impact the total amount, of your realized value at the end. But so in the shorter term time frame, getting the execution, because it's a higher proportion of, say one tick is a higher proportion. If you're getting 10 ticks, then you lose 10% versus, you get like 1,000 ticks. Well, I mean, it makes sense. The last look, I think, is really part of what I would consider the gray box. If there is a trader who's taking a decision, even if they follow the decision 95% of the time, 99% of the time, and they have that 1% of chance that they deviate, then really it's gray box, because that's a high enough percentage. Even 1% can change the overall distribution of what your backtest returns are and what your realized returns, because you might end up taking a human decision that has a massive impact on the portfolio. Because again, we talk about outliers and nonlinearity and all that jazz. It potentially could be that time you intervene that you actually get a really big benefit or a really negative consequence. So, I mean, I agree with your classification. There is still a benefit. Like if you were able to execute automatically and save yourself, say, 10 bips on every trade over the course of a few years, potentially that is worth it to automate. But because you, the human disciplined trader, or even you just you email a trade sheet to the broker who has a fiduciary duty to execute those trades as best as possible, then the difference between the black box automated execution and the human executed really shrinks down. Oh, look, Andy has come, the man of the hour who I was hoping to talk about this black box stuff with. So I will bring you to the stage.
Jeez, what am I walking into? Sorry I'm late. I had dad stuff I had to take care of. So give me a topic, because I just kind of got back from hiking through the woods for a soccer ball.
Oh no, so we were talking about like where is the line between gray box, black box? And so kind of what we've outlined is one place that it happens is an execution. Tim was saying that like the last look, like even if you had a complete system that gave you trades, then a trader or a portfolio manager is deciding to have a last look, that would be gray box. And then I had told about my experience being an intern in an options firm, whereby the trader actually can adjust the models on the fly, or like there's a coder who could do that, and then that would be like what I thought of was gray box. Black box is just fully automated from start to finish. Everything gets executed, returned back, job done.
Yeah, I agree with that. Gray black boxes, you don't, maybe you turn it on and off, but not even during the day. It's on every minute that it possibly could trade. That's how I would define it. Even if you shut it off during the flash crash, it's not a black box, because when you tell someone it's a black box, your pardon me, back test has to reflect, including the flash crash. It has to reflect everything. So I think that the tiniest drop of white, as in you're manually doing anything with your trading system, that's going to turn a black into a gray, just even the tiniest drop. So those are my thoughts.
Do you have? I think you're probably the most gray box person in the room, so I'm gonna dejuice you as much as I can. What do you think are the advantages or disadvantages of gray box versus black box, and why would you prefer one over the other?
I think black box is a whole lot easier. I mean, from my experience with just trying to get capital, black box is a whole lot easier sell. Because then they can run the back test, they can see the back test, they can say, well, what about this? And it's a few clicks. Obviously I'm simplifying it, but it's a whole lot easier to sell a black box. People tend to trust, and for obvious reasons, the consistency of computers, versus if you introduce a gray box, they feel like they have to get to know you, even if you're gonna, introduce a 1% of the time that you're gonna get involved. They're gonna treat it like you're getting involved 50% of the time. So, you get vetted, and they I feel like there are a whole lot of firms that I've talked to that only want black box. So it's a lot easier to sell. Gray box, it's difficult to do black box. Even if I were running it on my stat arb strategy, you know, I wouldn't have made a penny during that flash crash, because you can't just hit a bid and hit an ask. Like it was if you wouldn't have done a trade. Meanwhile, that probably doubled everyone's returns, by not having a black box and being able to finagle, figure out a way to get things done whenever in a market where nothing could get done. So what else? I well, I think gray box is better for just security of ideas. You can just on that regard, just general security. If someone sees your code, it's it's theirs too. Gray box doesn't allow that. I think there's also, on a benefit of a gray box, another one is, the human mind has this creativity involved, and in my mind, computers, that's kind of where they drop off. and you don't want to have to use creativity every day, because then you don't even have a gray box. You're just a shoot from the hip trader. But I think that an evolution of ideas is easier to evolve in a gray box. My personal experiences, the creativity of the human mind kind of thrives and needs that gray box. I just think it's better. I don't know how to put that into words. You'll have to give me some time on that.
This description that you, Andy, gave, it feels like gray box still like trading to me. I don't know. I understand you have your rules, you have your automated strategies that you twist and tweak with your intuition, maybe, or adjust to some market regime or something. But so with a gray box, there's definitely this hurdle to follow your rules, and you can like tweak and twist and adjust them too much and interfere with your own opinions. But if Derek, if you trade black box, like, do you more like to like retire old systems and develop new ones, or do you optimize and adjust them like I mean, if markets change or you see that some black box or strategy system is not acting well, or organization or something, or goes out of sync with the market, how do you manage those? Do you create a new one, or do you adjust it to the future trades? You obviously don't change anything on the open positions side, but yeah, how do you manage totally black box?
It's a really good question. And I think that's okay. How do I do it? I keep track of all of the strategies that I'm running. Now, um, I have them divided into families. So, like, you could think each family of strategies is targeting a set of factors or similar factors um, in the marketplace. And I have never retired a strategy, but I have a optimization process that's run weekly that will adjust the ones that are doing better and worse, I guess, over time. And it uses the Bayesian um, ideas that we've always espoused on this clubhouse to kind of guess if this thing is in favor or not. When it goes to zero, it's effectively off. But because it's still being monitored, it could come on in the following week or the following rebalancing period. And these rebalances are relatively stable because of the Bayesian updates and how fast they move. So it's not super quick reacting, but I think the term that Richard uses is razor sharp. It's razor sharp all of the time. And whole families have the potential, though it's never happened to me, but it's like to go to zero. I mean, a majority, like more than half of one set can go to zero just because that whole thing is really not working, but maybe there's a few parameters in there. And then that's where I can see that my method would be different than a human trader, because these things, like a vast majority of them are not working. But I still have ones on that are probably going to fail in the future, but I just follow it. And other ones that I don't see why necessarily they're being reactivated are coming back on. So this framework, I think, is probably one of the key aspects of what I do, because it allows infinite scalability into different factors and to different parameter sets and to different ways to process or calculate these specific strategies. And having this hierarchy allows me to kind of decompose what comes out, right? Because they're in these families. So I can see which particular factor families are producing, not producing, whatever. And then that actually gives me a great narrative to tell the client. So it has that hybrid method where it's like I've created, I mean, I guess you could call it machine learning. It's like a machine learning Bayesian update thing. But because of how I've created this hierarchy of systems, and I'm not taking anything out, um, if something is shut down for the next 10 years, it really doesn't matter, but also means that my research doesn't go in the garbage after all that time, because if markets are cyclical and that environment does come back, how would I, the human, know when to put that back into the basket? Um, so it removes that part of the uh, discretionary part. Like if I were to have, say, 5 factor families, I remove the one that's underperforming, say 60% of them are deactivated. I'll just remove the whole thing, reallocate to the ones that are working. Yes, at this point in time, and maybe for the foreseeable future, for however long this, update actually, provides value, it will be good. But there will be a point where I need to put it back, and I will be late because I don't know what my decision point is to do that. So I sacrifice computation time than human discretionary time to say, yeah, okay, the market is ready for this. And sometimes you get false triggers, just like you will have in any kind of trading system. It'll try to reactivate that specific factor family potentially too early, but then it will go back down. But just like with anything, if it does catch on, then that will be boosted over time. So that's how I do it. Was that clear?
Yeah, it was clear. Well, yeah, weekly feels quite frequent, but I assume you don't do any major changes every week. You just kind of like go over it systematically. But yeah, it makes sense. Thank you.
There's actually a brilliant point that is emerging from this conversation. And I think Andy brought it up. And it's this notion that once you come up with a system or a systematic way of doing things, that sort of curtails any creativity around the process. And certainly my experience has been quite the opposite. I come up with an idea, and then maybe a new idea follows that. Maybe I get other ideas which are hierarchically linked, and so are either above, higher in terms of order, or lower level respect, compared to the original idea. And so you can keep seeing this ideas sort of creating a space of individual things that you can add to your system. And then to echo what Derek was speaking about, having this continuous update system. So your signals are continuous and never discrete, and you modulate more or less of them depending on the opportunity set in the market is something that makes a lot of sense, and sort of reconcile everything back to what Andy was saying. I think the research gets integrated into the systematic running of strategies through this constant flow of um, creation of new ideas, new factors, new alphas, however you want to call it, new signals that you keep adding to your system. And then an allocator decides how many of those are picked up on a given day or week, or whenever you update your zoo of factors or signals.
To speak to, I think Bruno, I think that what I do is not just trading. I do have very systematic, but there are 4 different silos that I have found personally very difficult to integrate, which is why I mostly am gray box. But that's just a separate point. The other thing is, I had a real cathartic moment that I kind of wanted to talk about. I mentioned it last week in Derek's clubhouse, but it was a very cathartic moment where I was sitting there and something felt very, up at 4680, it felt like I knew that it was a good time to get out, but it wasn't in my system. And if I wasn't sitting there watching it, and I hadn't been watching it for days, I wouldn't have known. And at the time, it felt like I was just trading, like you say, like kind of going on gut instinct. But then once I had like 24 hours to process, like what happened was it led to a discovery that was completely logical and completely within the realm of my model. It just was tweaking the time frame of it. And I don't, I just feel, I feel like that would have been difficult to sense and to know that I needed to add a very important aspect to my model if I were fully black box. I just would have had a losing trade, and that would have been that. So I don't know. I found that interesting. I, if anyone wants to talk about that, we can talk about that. I have something related that I wanted to bring up, but I'll wait a few minutes.
Yeah, I want to touch on that actually. I'm not thinking about it on a trade by trade basis, but the speed at which I can come up with something that I've seen in the market. So I agree with Andy. Watching markets, understanding how they work, thinking about flows. I think that's something that's really missed in the trend following thing. That the flows are actually what's generating these trends. And you guys know that I do believe that macro things have these effects with force flows, and then you do have these large moves. But imagine I saw something or I see something changing. My research process will take me on the order of weeks to months to be able to implement any kind of change, and by that time it may be gone. But in Andy's case, and because of his experience, he will be able to execute on that instantly. And I do think in the moment that's probably better, but I don't think if you put me in Andy's seat, I could have done it. So, one is like the rock star, Andy's a rock star. He's able to do this type of things. And for me, I'm not sure I could have done it if you put me in the same thing. And so my sacrifice for not being able to do that is the time in development and hoping that alpha still exists by the time I get it online.
I think
Wait,
the
should oh,
sorry, Andy. No, but this is actually quite interesting. Um, we're talking about two slightly different things. Your ability, I mean, I agree you're a rock star by definition. So yeah, that's your name, rock star Andy. But you're actually talking about capturing something in the moment, which by definition can't be systematized. So, I fully agree with you about that. But, I still stand by my comment about, being able to integrate research into a systematic process and harvest persistent risk premia. This is something that, I still would like to do with a fully black box rather than a gray box.
is that one trade? It's just a one trade lag. So, it doesn't even really matter. And, as time goes to end, like it's just one trade that we're talking about. I did this one trade. I could have easily said I had a feeling at that time and not intervened. I just processed it quickly, but it's also like, if you guys knew how much I think about my model and how familiar I am with it, it's not, any sort of thing to be amazed by. But anyway, I think we're just talking about one trade. So I agree with you too. I just kind of did it very quickly because of my extreme familiarity with this.
No, but I think it gets to a point. I do believe that there are, you being one example of one of these gray box traders, and their ability to detect intuit. I will say it's in intuition. Whether it's because you've worked with your models, you designed them, and the markets that you trade, you detect an anomaly that would take me a lot longer because I would need heaps of data to do it, and you're able to identify it in the moment. And I will say that this, I'm not disparaging your systematicness or anything like that, but I believe it's possible for the human to add value, and I do believe that it's possible for, um, what Tim was saying, that if the model outputs something and there's PMs who have less look, it is possible for them to add value. The question is, because there's a human in that decision matrix, how do you train up other humans to do what you do or to do what they do?
And most of the point, how do you attribute the performance between man and machine? At some point, you would want to know whether you've been successful as a discretionary trader or as a systematic trader. I think that's where most of the my problem is a problem of measurement rather than all the good things that you guys have said. How do I or how do I objectively attribute performance in a gray box environment?
Yeah, that's a real issue in trying to sell it to somebody. And it's also to what to what Derek was saying. It, it's it's I don't need to, and when I anticipate, we all have fantasies of our systems, going larger, but like I don't need to train somebody in having that instinct, because it's just one trade. If they have an idea, then that's when we can test it and go back and back test it. But there's all different levels of all different companies where the people at the top are having a creative, quick mindset versus the other people in the it takes years in order to get to that creative mindset, and that's when someone gets promoted to the CEO or the executive level. But yeah, the attribution, like my performance would likely, it would suffer. Like I mean, I would have gotten out, not too bad, maybe 1% lower, um, but it's okay. You're paying, but in my mind, I'm paying a price for having that full black box, which is, and that's a small amount of performance. And again, these changes don't come around every 3 months. This is it. It normally probably averages a year or two before I have like a major tweak like that. So it's 1% every year. It's not a big deal. I'm just more of a technological standstill where I'm working on a whole lot of other, like capital raising and marketing. I'm prioritizing over connecting all four of my silo programs together.
No, I think you're right. 100% it's a cost. And then it's, because we're all running businesses here, is that cost worth it? And that goes to Marcus's original point. For the individual investor, potentially, um, it's not worth it. And if you are able to just execute that by hand or to have that in the middle, that's fine. But 1% can be a lot. Like if you're compounding that edge, that's an additional 1% that you didn't have before. And if you're able to repeat that, um, I mean, that's nothing to shake a stick at. You know what I mean? It is something that I don't have. I'm definitely jealous of the people that do have, because uh, that level of intuition, and I use the word intuition because I do believe that our human brains are pattern recognition machines, and sometimes those patterns aren't really there, and that's when we have cognitive bias. But when they are there, it's real. and then translating that into edge, into returns is what we do. Whether or not it's a repeatable, risk premia, it's still some human behavior behind. So I think that's an extremely granular kind of like laser focused intuition there, that is bringing you additional edge. Has anyone actually allocated to a gray box person before? I haven't. But I was just curious because that seems to be something that Andy was having issues with. Has anyone ever allocated to someone like that?
No, I haven't, but only once in my many discussions, people seem to have an interest for having a discretionary element. So not only I haven't allocated to that, but I've come across very few people that like this blending of systematic and discretion.
Yeah, I basically have to go to totally different firms. If a firm is systematic, I come to realize it's very unlikely and not worth my time to even pursue it. They basically ask, is it fully automated? I say no, and I can hear on the phone their eyes roll in the back of their head. So, yeah, I'm basically have to go through the more traditional channels of, just regular allocators who go, and I'm with guys with less systematic, and so I'm possibly the quantiest of the discretionary traders, high percentage anyway. But yeah, I that experience is all the same with me.
I found the other side of that coin, to be honest. Um, I felt like there were definitely prospects that were adverse to having a complete black box because they felt like they couldn't understand it. And I think that there's even a point where it's like, even if you did the turtle type of classic trend following, that they would be like, I want a human in there because what are you going to do during COVID, or like if X, whatever crash something. And so I don't know if it's that the gray box sits in the middle, or the people are just giving me excuses, because to get them to be confident in your system enough to allocate to it, if they are coming from more of the discretionary side, maybe they're um, focused on that, or you have like single family, multifamily offices that are, not so comfortable with that, or maybe they would prefer to go with a big name, that has a much longer proven track record, and you're trying to like break into the industry, go us. Um, they do have an apprehension. So I don't understand where the clients sit on the spectrum. I'm sure they probably all sit on different parts, but it's something that needs to be addressed, depending on who's sitting on the other side of that table.
That is interesting.
Hi everyone. Sorry, I joined a bit late. So for me, can you please just provide a simple definition? What is for you, like what is the difference between black and gray box?
It's funny, Arthur, because we spent the first like half an hour trying to discuss what is the definition, because so many people have so many different definition. So far, I think what we've come up with was, if there is a human in the decision aspect of the system, not necessarily a human doing the execution. If a system is outputting but a human executes, it will still be black box. But if there's a human in the decision matrix, then it is a gray box.
Okay, makes sense. I think in gray box, in most of say macro volatility trading, right? They would into gray box, and I think the guys are really like the one that I know, I heard of, are really good in finding asymmetric payoffs. So if you have some sort of view, right, say you say, well, high inflation will persist 1 year ahead, right? Then then the really good ones are the ones who can structure a payoff that effectively will maximize. If the view is correct, they will maximize, and that inherently it involves derivatives. It's either say term structure, volatility, cross asset volatility, correlations, and so on, right? And that would say for me would fall into say macro, all kind of macro that involve derivatives, not only say just trading bonds, but derivatives. And that is difficult. Like I think you already mentioned, the difficulty for systematic, it it's the sample size is so small that you cannot, right? And it's also, I think, in the end, it's more about asymmetry, because in classic, say, systematic trading, you prefer to have diversification, right? Even though in the end it's very hard, but you combine a lot of signals. And here, the opposite, that say in a say gray box, when you want to have put up say a view and you want to put up a big trade, there's no way to diversify, right? You are human. You cannot have say many ideas changing every day, right? And you won't be able to track it. So you have sort of, it's almost like you have to believe in some trade, and the goal is really to have, I think, for me, what would be the gray box is really person who can identify asymmetry and who can say place a very big trade but with limited downside and unlimited, like we say, very big upside should the view materialize.
I sort of feel like from based on what Arthur is saying and the rest of us, I think we're kind of searching possibly for a definition of gray box versus discretionary trader. And if that's the case, I'll throw my view. This is zero based in fact. So if someone gives me an actual definition, I will flip to the actual definition. But in my mind, gray box or black box is 100% automated. Gray box is, I'll say, 95%. You do the same thing every time. I mean, personally, I feel like I do it 99%. But that's gray box, follow the rules. And then I think anything less than 95% is discretionary trader. But I'm just throwing that out as a conversation starter or just my personal view.
Arthur brought up a really good point that hit home, and it's about structuring of derivatives. And especially, I'm systematic, global macro. Okay, you guys basically know what I do, but determining the optimal structure for a signal is a problem that we all have. We trade mostly the delta ones, or like the futures equities for anyone out there. The definition, and you're basically trading the underlying because it's easy, but it's not necessarily the optimal. And if you were to know that you had some signal that would be pervasive, searching all possibilities of the implementation is impossible. I mean, even if you think about, okay, it's probably possible, impossible for me. Even if you just look at vanilla options up to 3 years out on one underlying and find all the different potential structures to look at what Arthur said, just in the term structure volatility to find out the biggest asymmetric payoff, um, is a massive search space. And then you can imagine that you're targeting, say some macro factor that could be expressed through multiple markets. Are you willing to just trade, like he said, the U.S. Treasuries for inflation? Inflation swaps. What kind of inflation swaps? I guess in this environment, I might opt for CPI because it has energy in it. But what if you want you're trading swap against the Fed funds, or you structured something where you're selling some kind of optionality to cheapen it. So you could say like, okay, I'm going to do option on the 10-year Treasury conditional on S&P something. I don't know. These are the crazy things French banks like to try to sell me. Um, there are potentials for larger asymmetric payoffs, and would that be black box? Your signal is one thing. You assume that the model has come up with some indication that you should get into a position. And then this goes into like, is it human execution? Is that still 100% systematic? Because the computer can probably only do a limited amount of options. You could just say pure vanilla calls and puts, and or the delta one. But a human can say, okay, I have this signal. It's better for me to purchase a swap, or it's better for me to do something OTC because I'm going to get way more convexity, or I'm willing to sell this correlation against this to cheapen it, or you know maybe we've already had one leg down. I'm looking for the next leg down. Say in S&P 500, vols are up, skew is up. What am I going to do? Do I want to put on a spread? Do I want to try to pick it up in Europe instead and take some basis risk? Something like that. And that really opens up the world, I would say, because you add in a lot of potential convexity. You add in a lot of ways to cheapen your trade, but I'm not sure a system or a pure algorithmic execution would be able to go through that type of tree. And then I'm gonna ask, this is the question I'm posing to you guys. If a human structured the trade, what they believed optimally, targeting that signal, would that still be black box?
To me, what you're describing is so to answer your last question, it's 100% discretionary. Because here you're talking about timing the trade, you're talking about structuring the trade, and you're talking about executing the trade. So that specific scenario, 100% discretionary. Can you systematize and break down the process? It could be done systematically, but of course, and you hit on it perfectly. It's a search space problem. You have the curse of dimensionality, which means this n-dimensional cube. What's the probability of finding a certain mass? It goes to zero as fast as scaling up with the number of dimensions. So if you keep track of multiple instruments, multiple different markets, multiple maturity standards, and everything, you can't do it systematically. But you could reduce and optimize the search space in such a way that you could find the solution. So your question, the way you framed it, to me, it's totally discretionary. It is not something for us, but I believe that you could find a way of doing it systematically.
That's interesting because, I put it to the extreme, but I would say that because you're targeting a single factor from a signal that gave you the timing you need to execute now, and you're targeting some hopefully persistent, signal, you're just finding the optimal execution. So let's reduce the problem a bit. Um, let's assume that we don't have some crazy search thing just for pure options. What if you had a signal in the for trading an underlying, and then your system says that okay, should trade some options. Just on this underlying, no conditionals, no knock-ins, nothing exotic, just pure vanilla, some structure of pure vanillas. I know we had discussed that there is a company that can actually structure these things, but like, let's assume you did that by hand. Would that still be discretionary?
Well, it depends. You sort of understand my my answer. The answer is veering towards the no. I mean, like I come around your view of the world in that case, but again, I think it, it depends on how you frame the problem. In my opinion, there is a way. If you constrain your search space enough, then it could become totally systematic. But the way you framed it at the beginning or the first time round, it was so wide open that there's really no way of doing it with a computer. You have to be, you have to have some real human skill and intuition and knowledge, and it can't just be done programmatically. If you constrain yourself more and more, yes, and there's so if we are in vanilla space, no knockout, no kind of conditionals, and super liquid underlyings, then yes, I believe you can do it systematically. And of course, you will have some basis risk. So let's say that I'm hedging my 150 markets or whatever it is in the futures with 4 or 5 options, vanilla options, listed options. I think you can do it. Or certainly, this is my belief that I can do it. And I've also been quite open in the fact that for me, it's an open project. I haven't got a solution that works, but I firmly believe that one could be found.
No, for me, I constrain to just define the boundary condition, right? I mean, this is how I think. Um, I, I, I believe that you're right. When you add in all kinds of basis risk and conditional structures, because the human is deciding what's on the other leg of that thing, um, it becomes discretionary. Because if I have a conditional on, say, like I'm buying a put on, uh, you know, S&P 500, conditional on some level of inflation. That level I've decided, the measurement of inflation I've decided, or even doing it simpler, do that conditional on some level of the euro dollar spread. Um, Again, I chose this rate. Why didn't I choose the Fed overnight's rate? Why didn't I choose the 10-year or the 30-year, or geez, I could even choose the carry rate between USD JPY. Um, that adds quite a lot. And I think that, like you said, when it becomes constrained and you've reduced the search space, it becomes more systematic, and then that also helps the computer do it for you. So, like, if you were able to frame it in such a way that you were able to make it discretionary by human, you're getting to the borderline, I will say, where it could be fully automated.
I totally agree.
Just to add, I think it's the difficult always is market conditions, right? If they are changed or they are not the same. So a lot of these constituents like spreads, they dependent on past. That now we are talking some kind of very isolated events sometimes, like say uh, Fed tightening when I don't know the base rate is how much is 25 basis points still, and markets are at the all-time high, near all-time high. So it's a lot of these conditions where say you have to take a reasonable amount of say discretionary insight, but this is what makes a great trader to be a great trader, right? That out of say universe, it's not like in systematic trading you can say you have several ideas, you can backtest, given that they sort of that do not have some strong regime conditional, that the linear instruments, right? So you more or less have a good estimate of, say, based on historical scenarios. Here we have something that unreason, like Like, for example, like actually good example is before credit crisis, before 2008, there was this Morgan Stanley guy who correctly believed that subprime mortgages are due to correction, right? And in 2005 or 2006, they bought a lot of protection on equity tranches, right? But they were bleeding money and risk, right? So they actually they were forced to do something about the positions. So they decided that okay, that we are going to have equity, like say the worst part of mortgage market will be wiped out. So our position should be in place, but we are going to sell protection on senior, on triple A's, right? But because it's a spread thin, right? So they actually sold 8 times more protection that they had on equity tranche, right? And again, so it was kind of carry neutral at the time, was a carry neutral, but what they underestimated is the correlation, right? That when the crisis hit, implied correlation went to 1, so it's effectively telling you if you have one default in your subprime mortgage, it means that your AAA also will default, right? Because it's 1. And they were close, so they lost 9 billion, I think it was the biggest loss. And of course, on the other side, there were some guys like Paulson who did it right. So what I'm saying that it, to have a good, say, gray box or discretionary box, it's really important is to not depend on history, to have some sort of forward vision, and to have conditional on your scenario, you have to do some sort of optimal sizing with limited downside and unlimited upside.
I think that's super funny. Um, that they sold 8 times the protection, end up being right, but paying a massive price. And I think you're right. The biggest, best macro guys, you could think of your Soros or your Paulson or anything like that, have the ability to find these asymmetric payoffs. And, potentially it's all in their head because there's no way they could have back tested any of this kind of stuff. And then they're able to find the best structure, and opportunities for them might come, only one or two every 10 years because you need these really big blowouts. So necessarily, I think that their jobs are probably the best protected against the, distribution of more algorithmic trading, the ease of getting access to machine learning and things like that, because there will never be enough data for people to replicate that type of thinking and structuring in a repeatably back testable way.
That's such a great point.
That's actually just to add, to their say defense, there was no way to backtest the scene because I was in that area during the time. I think the highest number of simultaneous default in AAA or it was 2 or 3, right, per quarter. So you would never expect that all kind of you have systematic default where say whatever 20, 30 corporates, or we are talking okay of mortgages, but there would be a systematic spike in defaults. It never happened before. And actually what happened also, it was not because it realized its market was implied. The risk premium became so high, so effectively you don't need to wait to default for it to happen. It just market says, okay, that's it. It's we are there. Right? So what I'm saying is that sometimes it's not even possible to backtest this type of asymmetric events. Right, so it's really you have to be careful. You have to keep, say, steer, like visualize or It's why I think it's really difficult. Something also a good example is Brexit, right? That apparently there were funds that profited just because they apply, say, out of box thinking, and they actually hired independent pollsters, right? This is also to say it's a good idea, right? Like, and also at that time it was something new, right? Of course, going forward, whatever voting we have, like people will be applying, using like this kind of services, trying to predict or see asymmetry, right? At the time, no one thought that the Brexit would actually be possible because everyone was reporting like 70-80% support against it, and bah, suddenly it happened, right? And there were guys who profited from it, and that sort of what I'm saying, that it's really, I think, ability to gray box for me is both. It's applying some sort of vision, but also finding a ways to benefit from it in a asymmetric way. And so something that quants, like say quant traders, we won't be able to do, or is right within our models or within framework we think.
I 100% agree with that. There is that is the pinnacle, the of the human discretionary. I think they are the one in a million, the godly traders that are able to pull that off and to be able to have those type of mental models, not quant models, to see the world in such a way. And it especially pays off when it's never happened before. Because once it's happened before, at least we have one data point. Going from 0 to one data point is something, and then 1 to 10, and then it increases exponentially from there. But to be able to visualize something that's never happened in history, and then to calculate and structure a largely asymmetric payoff is, I don't know. That is definitely the type of stories and interviews I like to read in books.
Yeah, it's genius.
And also to mention, I think it's Sandy mentioned, for quant funds, actually, in my opinion, I think people underestimate the degree of discretionary influence you have over any program. And I mean, if it's always a question, like say, if I have a view, depends on of course, of many constraints, right? But I think even say within trend following system is definitely I can incorporate my view, right? You have, of course, you have say longer dated, say how what signals you use, what is say your trend following speed, right? If say if I want to have long bias, I reduce my trend following speed. I can introduce some additional thresholds, right, as to avoid frequent trading and have a long bias. Over short term, it's always you have most of you have threshold, right? You probably have a tracking errors, and you have always say navigate between actual positions and model based positions. So of course over long time it's probably not possible say to have say kind of control of your system, but over short to medium time you can definitely change it. I mean, that also for systematic trader is different mentalities to stay put, right? Stay put with your model. But nevertheless, if you want, you always know how to tweak your model in order to have your, say, execute your view, which you should not do, but you can.
Well, thank you everyone for this session. Actually, it was quite good. We're coming on an hour and a half. So I will wrap it up and hope to see you guys next week. Please, everyone who came today, message me, reply with topics you would like to see. I'm always trying to take ideas from our conversations to make sure that they're relevant. So I would really appreciate it if there's any kind of idea that comes into your head. I will be happy to put it on the weekly poll. So thank you, everyone, and have a good week.
Thank you, guys. Ciao.
Thank you. Bye.
Thank
Thanks,
you.
bye.
Bye.